Hey traders, I'm Charles, your AI assistant at Pipdemy Academy. Have you ever noticed that prices seem to bounce off certain levels again and again? That's because of support and resistance, two of the most important concepts in technical analysis. In this lesson, I'll show you what support and resistance are, how to identify them, and how to use them to find high-probability trades. Let's get started. Support and resistance are key price levels where the market reacts. Support is like the floor. It stops prices from falling further because buyers step in. Resistance is like the ceiling. It prevents prices from rising higher as sellers take control. These levels are where traders look for buying and selling opportunities, making them crucial for smart trading. Finding support and resistance is easier than you think. Just look for areas where price has reversed multiple times. These are your key levels. The more times price bounces off a level, the stronger it is. Traders use past highs and lows to predict future market reactions and plan their trades accordingly. Smart traders buy near support when prices are low and sell near resistance when prices are high. You can also place your stop loss below support for buys or above resistance for sells to manage risk. This helps you enter at the best price and avoid unnecessary losses. Breakouts happen when the price moves beyond a key support or resistance level, signaling a potential strong trend in that direction. A valid breakout often leads to a significant price movement as new buyers or sellers jump in, expecting the trend to continue. However, not all breakouts are real. Fakeouts occur when the price briefly moves past a level but then reverses quickly, trapping traders who entered too early. This happens when big players manipulate the market, or when there isn't enough momentum to sustain the breakout. So, how do you avoid getting caught in a fakeout? Wait for confirmation. This could mean a retest of the broken level before continuing in the breakout direction, increased volume supporting the move, a strong candlestick close beyond the level. By being patient and waiting for confirmation, you'll avoid unnecessary losses and trade with higher confidence. Support and resistance levels are often thought of as fixed horizontal lines, but in reality, they can also be dynamic, meaning they change over time. Trend lines as dynamic support and resistance. When the market is trending upward, a diagonal trend line can act as support, meaning price bounces off it as buyers step in. In a downtrend, the trend line acts as resistance, where price struggles to break above. Traders use these trend lines to identify entry points in a trending market. Moving averages, 50 and 200 MA, as support and resistance moving averages like the 50-period and 200-period moving averages, act as floating support or resistance levels. When the price is above the 50 MA, it often bounces off it as support. When it's below, the 50 MA acts as resistance, pushing the price down. The 200 MA is a key level that many institutional traders watch. It often defines the long-term trend. Why use both? Combining trend lines and moving averages gives traders a stronger confirmation of support and resistance levels. If a trend line and a moving average align at the same price level, that area becomes an even stronger zone for potential price reversals or breakouts. Great job, traders! Support and resistance are key price levels where price reacts, helping you spot high-probability trades. Use them wisely to find entry and exit points and manage risk effectively. But remember, always confirm breakouts to avoid fakeouts. Pipdemy is here to help you trade smarter. Keep practicing, and I'll see you in the next lesson.